Welcome back, business management students. We are looking at financial management. So this is the third session for financial management, and today we are looking at financial analysis, financial planning, and financial control. So I hope by the end of this session we have covered financial ratios. It's important for us to understand that financial analysis is necessary to monitor the general financial position of an organization or of a business and to limit the risk of financial failure of the business as far as possible. Financial managers have a number of tools at their disposal to conduct financial analysis, and these include the financial statement or the statement of the financial performance, the statement of financial position, which is also sometimes referred to as the balance sheet, and financial ratios. So the statement of financial performance, some say a business can actually realize profit and it can still fail. The reason for that being you can still record the profit figure in your statement, in your financial statement, but that profit may not be in cash because sales can also be on credit. So if those sales were not in cash, you may still not have that money or those finances to use in the day-to-day operations of the business, and the business can still fail. So yes, a business can make a profit or can record a profit and still have financial problems. A business can record a financial profit and still have cash flow problems. The other document another tool is the statement of the financial position, which is the balance sheet. And this balance sheet generally shows us the assets, both current and fixed assets, as well as how those assets were financed. So they can be financed through liabilities, both current and non-current. They can also be financed through capital. So we find that information in the statement of the financial position. Then we have the ratios, the financial ratios, which I'm more interested in because these show or they give a clear picture of the financial performance of the organization. And I know in this session we have more time to dwell on the ratios. So this is generally the statement of the financial position, showing the net sales, gross profit, net profit, operating profit, taxing, and also all those undistributed profits. So generally we're trying to see how profit was generated over a period of time. The statement of the financial position, we have described this, that it shows the assets and how those assets were financed. So ratio analysis or financial ratios. A financial ratio gives the relationship between two items or two groups of items in the financial statements, and these statements may be from both be it the cash flow statement, be it the statement of the financial position or the financial statement of the organization. They serve as performance criterion to point out potential strengths as well as potential weaknesses of the business. So we'll look at the common ratios that you ought to know at this stage, and we'll start by looking at liquidity ratios. And these, they indicate the ability of a business to meet its short-term obligations as they become due without curtailing or ceasing normal activities. So when we say without curtailing or without ceasing the normal activities, we are basically saying in financial terms, without affecting the general or the normal operations of the business. How normal operations of a business are affected? They are affected in most cases when we dispose of our fixed assets. So we are basically saying in this, when we're looking at liquidity ratios, or when we are looking at liquidity, we are saying to what extent can we actually meet our short-term obligations? To what extent can we pay our current liabilities without selling our fixed assets or without liquidating our fixed assets? Because the moment we start to sell land, property, and other fixed assets, obviously will affect the general or the normal operations of the business. So there are two ratios that are important that help us to assess the liquidity of an organization or the liquidity of a business. We have what is known as the current ratio, which generally we can generally calculate that using the formula current assets, then we divide by current liabilities. So it's current assets divided by current liabilities. The generally acceptable ratio there, it's 2:1. That your current assets should always double your current liabilities. The reason for that, remember, part of the current assets, we also have stock, which is not easily convertible into cash. So the value of current assets should always double that of current liabilities if we are not to affect the normal operations of the business when we want to meet our short-term obligations. Then we also have what is known as the acid test ratio. And in this case, we deduct inventory from current assets and we divide by the current liabilities. And the ratio that is generally acceptable as the acid test ratio for organizations is 1:1, because we will already have removed our inventory. Then we also have what are known as solvency ratios. And solvency indicate the ability of a business to repay its debts from the sale of assets on cessation of its activities. Assuming the business is to close, will it be able to pay everyone that it is owing only from the sale of its assets? So we have what is known as the debt ratio. And to calculate the debt ratio, just divide the total debt by your total assets. And the debt ratio is usually expressed as a percentage. You don't leave it as a ratio. The other thing with other ratios that we just looked at, you always have to simplify those ratios, and as a matter of principle, the right side of the ratio should always be equal to 1. Hence, you see, even in the examples that we give you, that you ought to refer to in your textbook, all the ratios that we calculated, we had to simplify them, and the right side, we always leave it up as equal to 1. However, when it comes to the debt ratio, we always express it as a percentage. So using the example that was given in the textbook, you can actually follow and see through this easy calculation how the debt ratio can be calculated. Then we also have gearing ratio, where we want to assess the extent to which an organization is financed by debt. So in this case, we divide owner's equity, that is basically owner's capital, that which was contributed by the shareholders, we divide it by what we borrowed, which is the total debt. And the gearing ratio, we express it as a ratio, meaning the right side of that ratio should always be equal to 1. We also have profitability and rate of return or yield ratios, which you guys ought to also know. And these are all expressed as percentages. So we have what is known as the gross profit margin, where you divide your gross profit by sales and you express it as a percentage. We also have a net profit margin, where you divide the net profit by your sales and you express it as a percentage. Then we also have the return on total capital. And to calculate it, you divide your net profit after tax, which you find in the statement of financial performance, and you divide it by owner's equity plus non-current liabilities, and you express it as a percentage. Then return on owner's equity, you also divide your net profit by the owner's equity, total value of owner's equity, and you express it as a percentage.